is Tuesday, May 20th, 2025. I'm going to show you two views of the market. One is very positive, Tom Lee of Fundstrat, and Jeremy Grantham, the great Jeremy Grantham, with a negative view. I think they're looking at different time periods. Tom Lee, more of a short-term, intermediate-term view. Jeremy Grantham, more of a long-term macro view. They could both be right, actually. When I look at on YouTube, you look at it because you're looking at my video. And when I look at the various people who have something to say about the direction of the market, I find those who are optimistic, we're in, fairy tale land or something, and it's just going to keep on going, and they're optimistic. As a matter of fact, most of the time, they're always optimistic. Then you find those who are pessimistic, and boy, there's a lot of them who think this is going to hell in a handbasket. It's going to crash tomorrow. This is going to be the crash of all crashes, down 50% or 60 or whatever. Terrible news. And they can't both be right. So how do you sort all that out? I'm looking at this thinking, they're not wrong, but some of them are wrong. And they just have an opinion. That's all it is an opinion. If I told you what I think, that's an opinion. And there's some of them that even have a terrible track record, but they keep putting this out, and I think they end up having a following of people who want to hear that particular message or kind of message. So I try to not do that. I try to give both sides of it, and that's going to be today. I'm going to give a positive view, and I'm going to give the negative view. Okay, I am Ben Reppond. Thank you for watching my YouTube broadcast. Today is Tuesday, 2025. Okay, I'm going to begin with this interview that Scott Wapner does with Tom Lee. Now, Tom Lee is interviewed quite a bit, and he's on CNBC quite a bit, and there are people who say he always has a positive view of the market. And so when it's a positive view, they go, that's not even an independent, credible view, because no matter what's going on, he always says that. Well, I don't know about that. But I do know that he does make the case, the rationale for the market going up. When he has said that, when I've been listening to him, he's usually been right. Now, we've been in an up market. So if he says that and the market goes down, maybe I'll lose faith in Tom Lee. But I think if you're an optimist and you want to see that the market is going up and that's where, the table is being set for a bull market or a new bull market or a continuation bull market, okay, Tom Lee's your guy. So I think and it's not without rationale. He gives good reason for what he says. So take a listen to this interview.
And our next guest argues the risk reward is much better now than even before the trade war started. Fundstrat's Tom Lee is a CNBC contributor and joins us now from Miami. It's good to see you as always. How's that possible? How's the risk reward better now than then?
Scott, I think when we go back to February, when the market was at all-time highs, we have to keep in mind we had a lot of uncertainties ahead of us, and we weren't necessarily looking at 2026. The tariff visibility is much better today than it was 3 months ago. And when we look at 2026, I think that there are things to look forward to, such as deregulation, tax cuts, and actually a Fed that's on hold now, but probably doing more cuts now in 2026. And then from a company perspective, companies survived, I think, a black swan event. That waterfall decline in equities and the sort of the near heart attack of the economy was an environment where companies produced earnings that beat expectations. So this is the fifth stress test for businesses. When I put all that together, I think PE's probably going to be higher in 6 months than lower. And when you think about 2026 earnings having upside, I think there's still upside for stocks.
So, because you keep talking about 26, you're not writing off the rest of this year. We still have 7 months to go.
Yeah, we have a lot of history to make between now and year end. But keep in mind that that waterfall decline in stocks also was almost a complete reset in positioning and sentiment. You know, investors were forced to liquidate when the VIX hit 60. We know a lot of institutions didn't add risk back as the market rallied. So I think the pullbacks are going to be pretty shallow because investors just are underinvested at the moment. And then when you look at sentiment, it's barely turning neutral now. So if investors have been fighting this rally, as they become more neutral or more optimistic, that's upside for stocks.
I mean, Professor Jeremy Siegel, like you, has grown more bullish, pointing out, in his words, the Trump pivot on the tariffs, but he still acknowledges the fact that the tariffs are likely to remain in place. Whether it's 30 on China and 10 on everybody else, that's still somewhat regressive, is it not?
Yeah, well, I mean, you know, we are now in a new world of tariffs, and businesses are adjusting. I think one of the things that we're seeing is that the market is now in a position where they can start to look through some of the messy adjustments, right? We know there's been a disruption to the supply chain. I think stocks can look through that. But you're right, Scott, there is now this world where there's essentially a consumption tax in place on things that we're importing. But that doesn't mean we have to actually have the PE decline or the markets to fall. It's now just something we have to kind of manage through.
Okay, now I'm going to give you a view from Jeremy Grantham. This is the first television interview that he has ever done in his life. He has been interviewed on Bloomberg and others that are more not TV. Even if it's Bloomberg TV, it's not, you know, mainstream TV. So Consuelo Mack is a financial journalist, a reporter. She interviews him. She does a very good job. And gives him plenty of room to unpack what he has to say. But remember, Jeremy Grantham, he's in his 80s now, he is a macro strategist. So if you're looking at what's going to happen this month or this year, it may not apply because he's looking at decades of time and sees it from, you know, he goes back to the Great Depression, 73, 74, 79 to 81, 82, 2000 internet bubble, housing market crash, etc. He looks at all of those, and so when he's predicting whatever's going to come next, he looks at it from that kind of view. He is not a perma bear. He has had times where he has been optimistic about this is the time to get invested. So I respect him from the fact that he's not looking at just the negative, but at this point he is negative. And he talks about that there is risk in U.S. equities, that where we are on a price-earnings ratio right now and the multiple that is being used to develop valuations is extremely high, and that he sees a crash coming that is a 50% decline kind of crash. Again, he doesn't put a time frame on it, so I don't personally think it's right around the corner. But he makes the case for the fact that this has happened and it will happen again. He puts his own story in so you can see what he was doing during that period of time. Because he's a strategist, a thinker, he's interesting to listen to. So I hope you enjoy this. Take a listen to Consuelo Mack and Jeremy Grantham.
We were talking earlier that outside it's a pea super. You can't even see the next building. And that's a pretty good analogy with the market from my perspective. It's seldom easy to see what's coming. You only get a little kind of glimpse through what they used to call the fog of war. And now you don't even get that glimpse. All the old ratios don't seem to work for a variety of reasons, but you start with COVID. COVID rattled the world to its bones, and then the COVID stimulus was an order of magnitude bigger than anything we had ever seen. And it ended up with trillions of dollars in very weird hands. People who were bored and forced to be at home with nothing to do but speculate on stocks, and they did. And it stayed that way. So even in the recent decline, the selling was by institutions, the buying was by individuals. This is incredibly new. So that's influence number one. The second great difference here that's also changed all the traditional responses is the introduction of AI, which really came to be recognized with ChatGPT in October 22. And we were having what you might call a traditional bear market. And it kind of ended overnight with half a dozen Mag 7, half a dozen, roaring upwards and eventually dragging the market with it. That cut right across all the traditional reflexes. And then finally, we have a tariff war. So if anyone can unravel that series of abnormal influences, we're still unpredictable because of COVID response. We're certainly still unpredictable because of AI. No one knows what AI is going to do. It's going to change the world, but no one knows when and how. And on top of all that, no one has a clue what the tariff war is going to do and how quickly it will do it. Are we going to have a major recession, a small recession, none at all? The economists are completely at sea, in case you hadn't noticed that.
Right.
You can find an economist with any view today on a huge spectrum. And since the stock market, in a way, takes its lead from the economy, and no one knows what's happening to the economy. So they're the three levels of abnormal responses that have completely scrambled the market. And makes it very, very hard to know what's going on.
Number one, the fact that you described it and noticed it and marked it is so you, Jeremy. You're connecting dots and you're noticing things that are completely kind of off the wall, abnormal, whatever it is. But it strikes me that what you're describing too are extremes in the market. And that's, again, kind of one of your expertises is to say that something is amiss, something's unusual, and therefore, what are you telling yourself? What are you telling your friends? What are you telling, GMO about what these abnormalities are telling you?
Well, the single thing all three have in common is that they should increase your respect for risk, volatility, uncertainty, be more careful than normal. That's kind of round one. And then round two, you back down to looking at more traditional views of the market. And the ones I respect the most, the ones that have provably the best predictable record over many years, over 7, 8, 9, 10 years, they all say that the market is about as high in December recently as it has ever been in history, higher than 1929, and at least as high as 2000 and as high as the recent peak in December 21. But the most predictable ones are variants of the total market cap versus the GDP.
Okay.
Which is said to be Warren Buffett's favorite.
Right.
And there are fairly elegant, serious variants of that. And Hussman does a very well worked out variant, which he believes is the single most predictive. And I have no reason to doubt it, since we have a very similar model at GMO. And that suggests that the market could easily go down by 50% and be well within its historical boundary. That would not be a colossal low. A colossal low, I've been through a couple, 1982, 1974. They sold at 7 times earnings, 7 times depressed earnings, for heaven's sake. The market, by the way, loves double counting. When it has peak profit margins, it has peak PEs. And when it has terrible profit margins like 74, it has terrible PEs. So 7 times terrible earnings goes up to 35 times wonderful earnings in 2000, guaranteeing that 74 to 2000 was one hell of a good trip.
Right. The market can be overvalued for a long, long time. So you take that information, and what do you do with it? You said just be aware that there's a lot of risk in the market, but give us some concrete steps that we might want to consider taking?
The quote attributed to Keynes, although he unfortunately never said it, he should have said it, is that the market can stay irrational longer than the investor can stay solvent.
Yes.
And that's really true. If you're in the institutional business, as we have been, you run the risk of getting forced out of your positions, even if you're right. And in 2000, we were right. The PE went to a new all-time high in January 98. It overtook the previous high of 1929 at the top of the legendary bull market. And then it just kept going. 21 times earnings, 23, 27, 29, 31. Oh my God, it has to stop. 33, 35. And at 35 times earnings in March of 2000, it finally quit. And how were you to know once you were in new high territory like that? And earnings continued to rise. So you not only went from 21 to 35, which is kind of a 50% hit, but you had earnings go up 20 as well. And of course, there's no way of knowing. And all you know is that in the end, it doesn't change the outcome. It just meant that the break from 35 times earnings was spectacular. And the NASDAQ that led the charge upwards went down pretty much 80%. And the same in Japan, although Japan is even worse. Japan had never sold over 25 times earnings, and then it did. And for some miraculous reason, we stayed invested until about 45 times, and then we got out. We said, this is ridiculous, we're out of it, 100% out. It was the biggest part of foreign portfolios, the EFA index, and we went to zero. And then we watched as it went from 45 to 50 to 55 to, you must be kidding me, to 60 to 65 times earnings, by which time we had underperformed by 10 points a year. It came back all the way, only instead of taking 5 years, it took 20 years. And now Japan finally is an ordinary country selling a little bit cheaply from the highest price of any major market ever by a lot. So you have a wonderful ride on the way up. It changes nothing. Eventually they come down.
Now I want to give you a few charts. They came out this morning, so these are fresh off the press. This Moody's downgraded the U.S. debt, and when I say debt, I mean bonds. They downgraded the U.S. Bonds, and so what that means is that bonds have now, the U.S. has to start paying a higher yield to attract investors because the quality of our bonds are not as high as they used to be. So you can see this is a view going back to 2023. You can see the up and down of that, and here we are at nearly an all-time high in yield. So remember, the price of bonds is inversely correlated with yield. So as yield goes up, the price of bonds go down. And no surprise that bonds are down this morning. They've been in a long 5-year decline cycle and do not appear to be going up anytime soon. So the yield on the 30-year government bond, 4.96%, nearly 5%. And that's good if you're looking for that yield. It's not good if you're in a portfolio that has bonds, and a lot of portfolios do. The University of Michigan Consumer Sentiment Index came out, and it is down. It is at 50%. When it goes below 50, that is pretty bearish territory, and it looks like it's headed that direction. They expected it to be up around 53, and it actually was about 50. So surprising to the downside. The University of Michigan also does the consumer expectation of inflation. And the far right, you can see the line that goes up. This is what the consumer is expecting in terms of inflation over the next year. So above 7%, actually it's 7.3%. That's a high rate of inflation. Okay, well, thank you for watching. If you have questions or comments, put them in the comment section below.